Today, we're going to start the session with a discussion with Zain Jaffer, partner at Bluefield Capital. I have known Zain for a while. He was in our Entrepreneur Journeys series as well. You may have already read that story. Zain, welcome to the show.
Thank you for having me. Good to be on again.
Zain, tell us a bit about your I guess we'll focus today's work primarily on the investing activity that you have more recently started. But if you want to set some context for people about your fascinating entrepreneurial background, that would be great.
Sure, I would call myself an entrepreneur in terms of, as soon as I discovered computers, I started to mess around and code and design things. So I've always been at it, trying to build things. And sometimes it's worked out, right? Most of the time it doesn't, it fails. But I've had, a lot of attempts, and all you need is to be lucky once. And it can, change your life completely. So I had a big exit. It was $780 million back in 2019, where I started an advertising tech company. And after that, which sort of has seen me transition from being a founder operator into more of a capital allocator or VC. I set up my family office where I started making investments, and then I decided to professionalize that. And I joined a fund called Bluefield Capital, and I set up a venture capital fund. Our focus is more unique because we invest in PropTech startups. So these are startups that target the real estate sector.
And why did you choose this sector? What in your background or in your history leads up to this choice?
I'd say it's envy, right? Or jealousy. As a founder, your entire net worth is tied up in your one illiquid startup stock. And it's a crazy journey. Sometimes you just want stability. It takes a toll on you when your net worth fluctuates like that, and you could lose your entire, you know, not even life savings, your investors' money, right? When you raise tens of millions of dollars from investors, it's scary. So I saw on the other side, you've got people making money in real estate, and frankly, they're not doing much.
Yeah.
They're leveraging up, they're getting great terms, they're getting cash flow. I wasn't even taking the salary for so many years. So it was very tough seeing, other people make really good returns, take their salary. I was like, I want a piece of that. But, here I am, no salary, banking with investor capital, trying to grow something big. And I also saw the returns. And the returns are amazing in real estate. And it feels like you don't have to do much. Things just keep appreciating. So I really wanted to get into that. And I felt that once you reach a certain level of wealth, real estate becomes a core part of the portfolio that you have. You'll have stocks, you'll have bonds, you'll have alternatives such as crypto and startups, venture capital, but also real estate. And I also realized a lot of people seem to be making money in real estate. And I got to tell you, now that I'm on the other side where we're buying real estate, you make money because it's so broken. 50% of the people don't know what they're doing, which is why it's kind of easy to make money, right? But also a lot of information asymmetry, and the market seems really ripe where technology can come in, can create transparency, can automate a lot of processes. It's just, to use stereotypes, a lot of old white money, at least in America. And when
Mhm.
you have a situation like that, it's exciting because people think the old school way is a mentality of don't fix it if it ain't broken. And I just thought to myself, okay, one of the world's largest asset classes, hundreds of trillions of dollars in real estate, clearly can be run more efficiently. And so I just thought, massive opportunity. Ultimately, I thought I want to start a company in this category, but to start with, let me be a VC for a while. Let me learn the dynamics of the industry, and from that, I'll figure out where to go next. And I thought we're in a unique position because I'm buying real estate via Bluefield. Bluefield has billions of dollars worth of real estate in its portfolio now. We have a lot of multifamily apartments, hospitality assets, which means hotels. We have senior care facilities. We have industrial warehouses. We're doing construction. And so, whilst I'm there, when I'm buying real estate, I thought, what a great platform to be a strategic investor and also set up a venture capital fund. And it's sort of I sort of felt, and this is probably my founder mindset when it comes to VC. When you start a company, you want to find a niche. You don't want to go after like something everyone's doing. You want to find a really, really, niche area where you feel like you've got skills and expertise that can match it. So my thesis was, when you look at the venture ecosystem, you've got these very large generalist funds that have an unfair advantage against all other funds. They can deploy capital at immense amounts. The cost of capital is lower. They've got huge amounts of capital under management. They can be broad sector players and they can afford to come in later stage. Normal VCs are getting crushed under that mentality. And so
Hmm.
if that's one end of the spectrum, and the other end of the spectrum, you have niche players, players that are either geographically focused or sector focused
Yeah.
or size focused, like pre-seed accelerator is size focused, right?
Yeah.
Or we only do pre-series A, or we do secondary, that size, but that's still not enough. So then you either become the local person where I invest in everything in, you know, Utah, Salt Lake City, where I invest in, only Silicon Valley startups, or it's sector focused like we are, where we only invest in real estate focused startups and at the seed and early seed. So that was my thesis that we come into the venture game and have an unfair advantage. And it's an unfair advantage also not just because we're sector focused and stage focused, but we have real estate in our portfolio. So theoretically, we can test we can run pilots, we can get superior due diligence. I kid you not, I've seen VCs in the prop tech ecosystem get pitched I don't know, a retail concept or an apartment concept. And what do? They called their residential broker who bought their $50 million home in Atherton. And they asked the residential broker, what do you think of this idea? Those VCs, frankly, I mean, not all VCs. There are some amazing VCs in the sector, but when you have so much sort of generality, you're not going to be able to do better. You're not going to be able to do superior due diligence usually. So I felt we've got an edge there.
Okay, so let's focus on the prop tech part of your work. And you said you're doing what, pre-seed and seed in that
Yes,
sector? Yeah.
exactly. Yes.
Okay. And is it all United States, some specific part of United States? What's the geographical boundary of this?
We try to stay focused on the US markets, but we are also open and have done many companies, maybe one third of our portfolio now are companies who plan to expand to the US, or they may be based anywhere in the world, but they just happen to have US customers. And, it's a key strategic market for them. Ideally, the US is the top focus, though, or is
Got
going to become the major revenue driver.
Okay, so now I'm going to double click down on prop tech. And how do you analyze the prop tech trends? What are the key trends? What are the key developments in the market? So give us like a little primer on prop tech.
So much opportunity. Look, when I started my company back when apps were taking off, as a founder, I looked at maybe five different areas and I had to pick one. And I kid you not, every single one of those five areas resulted in multiple unicorns. Even the top five companies in each of these five categories became unicorns. When I looked at real estate and prop tech, there were like 50 categories. So to me, it was like, wow, what a great time to be entering the industry because even if you're not the number one player in a part of prop tech, the market is so large that it can support billion dollar outcomes. When you try to analyze the prop tech ecosystem, there's a few ways to do it. One is based on workflow, where you look at the stages of work that's required in a transaction. The other way to look at it is by dividing it into asset classes, and you can sort of apply this matrix structure. So I'll give you an example. Let's start with the easy one by asset classes. Okay. You can just simply take a map of the real estate ecosystem, and you can say there is residential, which is the largest segment, and that's driven by consumers primarily, and it's got an ecosystem around it. But you also have commercial real estate investment, and within commercial real estate investment, you have multifamily apartments. And even within multifamily apartments, you have Class A luxury high-rise skyscrapers. You have workforce housing where you have Section 8, and I'm using American terminology here, but the equivalent of that is, where it's supported by the government and subsidized and it's low income. And you can zoom out again and you can do the same for hotels. You can do the same for senior care facilities, industrial, or alternative real estate or government real estate. So that's one way to dissect the prop tech ecosystem. to find startups that are focused on what I would say is a niche, but conveniently a multi-billion or multi-hundred-billion-dollar niche, you know? The other way to look at it is based on flow. And again, you can apply this matrix to any one of these individual sub areas. So I'll give you the example of a workflow for a company like ourselves.
Mm-hmm.
Newfield primarily has, as I mentioned, billions of dollars of real estate in its portfolio. Here's the workflow. Number one, you need to identify assets.
Mm-hmm.
How do we identify assets today? Word of mouth. And there is an amazing opportunity to think about different startups that can help with the identification of assets. Then you underwrite assets. How do you do it today? You use spreadsheets and you use your gut. Literally, it's your gut. You know, you see so many real estate deals where eventually it's like comparing shoes, right? Oh, this feels like a good place. You know, I feel really good about this. Let's go in and buy it. I mean, technology definitely can be used there, and AI can be used there, right? Now you've looked at real estate, you've identified it, you've done the underwriting process and analysis, and there's brokers involved there too sometimes, okay? Then you think about how do I actually manage this? And that's where you get operations. And within operations, you have things like property management.
Mm-hmm.
That means collecting rents.
Mm-hmm.
That means undergoing renovation projects. It might be construction and renovation, which are huge areas for disruption, right? So I'm zooming out now, right? So you've got management of the asset and evaluation analysis. And then what you have ultimately is the disposition of the asset. How do you sell the asset? The buy side, the sell side, the transaction side. And so that's an example of a workflow-based approach. And when we started out with creating this venture fund, we thought, let's try to be more efficient in our workflow processes. Because, you know, ultimately we're a strategic investor. And when you come across a strategic investor, they look at the world differently than a traditional venture capitalist. What I would say is that as time has evolved, our view has evolved too, where we're not going to be able to run pilots with every company that we want to work with. By the time I finish running a pilot with a startup in our portfolio of, you know, hotels, for example, they've already like got so much traction, they've probably raised the next round of financing. So we now think more like generic VCs where it's based on broader trends. But we do like to find startups where there are synergies with our own real estate portfolio.
Mm-hmm. Now, as you are looking at this space, what is the scope and scale of the number of startups operating in North America, let's say in the US? How many startups are operating in the prop tech space?
I saw about 500 startups last year, and that's just through what I tracked in my CRM.
Mm-hmm.
And there are thousands of startups. These are startups that were actively raising capital. So the number is mind-boggling. But of course, I think with any industry, you know, there'll be a lot of players, only a few will make it. So the number is enormous. I don't know what the actual number is, but PropTech is becoming a big segment. PropTech actually evolved. I would say it was a niche segment that was the intersection of fintech and maybe marketplaces and potentially on demand, the economy, and also construction, which is an even smaller niche. PropTech is now standing out as its own niche. Most of the venture dollars that have been deployed over the last few years have gone into fintech. And I
Mm-hmm.
think now that fintech's becoming very saturated, and I don't mean saturated as in opportunities, I just mean there's a lot of dollars chasing fintech, right?
There's a
PropTech
lot of dollars chasing fintech.
Right. So prop tech, I think now needs to be broken out of fintech and needs a specialist perspective. And even within prop tech, you get specialist funds that are dealing with these different segments. So look, the answer is I don't know how many startups there are, but there are lots of startups, you know, and there's no shortage of deal flow on the VC side for sure.
Yeah. No, I mean, we've seen a couple of prop tech startups within our portfolio. So one in augmented reality and one in marketplaces. So we have these companies in the portfolio right now. So yeah, we are seeing PropTech. Now let's do a couple of case studies of companies that you have invested in PropTech. And as you're talking about them, I'm sure you're excited about the value proposition and so forth, but I also want to understand how they came to you, in what shape they came to you, and what did you see in them that drew your attention sufficiently to want you to write checks?
Yeah. So we partner a lot with early stage accelerators and incubators.
Mm-hmm.
there seems to be this gap still at the pre-seed and almost at seed stage, and definitely for a while pre-Series A. And so we came across a startup called Stake.rent.
Mm-hmm.
And I can't disclose confidential numbers, but let's say it's one of the best investments we've ever made, right? And Stake.rent was founded by a guy called Roland Hobbs. He previously had run a few startups, which we like. He was very UX and design focused. And he had designed some of the loyalty programs for some of the world's largest brands. I don't want to get the brands wrong, but I think within that were names or similar names like Chase, United Airlines, some of the Marriott or some of the largest hotels in the world, right? And he felt that renters are not really treated with much respect. There's no such thing as a loyalty program for renters.
Mm-hmm.
You have loyalty programs for guests, but why don't you have loyalty programs for the long-term renter? It was a really unique concept. I liked it. And so I went to the demo day of this accelerator. I think it was Shadow Ventures, I think, what might have been the accelerator that was showcasing stakes. I tuned in. It was like a 5 or 10 minute pitch, which is very difficult, right? But from that, I looked at maybe 10 companies and I thought, Stake seems really interesting. And I like the founder's passion, UX background. He wants to create this loyalty program, whatever that means, right? Okay. Got to understand the concept. Like when the founder comes up with a term like that, you don't want to dismiss it. You want to try to understand in the head of the founder, what is the founder seeing that I'm not seeing? So that got me excited. Um, Talk to the founder and he tells me, look, you should reward renters for doing actions like paying rent on time. I'm like, okay, why? Well, if they pay their rent on time, then you're not going to have delinquency issues. You're not going to have, through COVID, for example, lots of people weren't able to pay their rent,
Yeah.
relying on government assistance. And sometimes when you run a property, you give a concession. A concession means move in now and you get 1 month free rent. And he's like, don't do stupid things like that. Instead, say to the renter, if you sign up now, we'll give you $200 in your pocket. I think this is a really interesting way of looking at things. And so as I talk to Roland, I think to myself, okay, he's saying this, but this is really just an idea. How do we test this out? And so we own real estate conveniently. And so what do? I call up some of the property managers who manage our real estate, and we say, hey, look, I got this crazy guy, Roland, with some crazy ideas. Can you take a meeting with him? I take a meeting, they take meetings with him, and one of my property managers come back and says, "Oh my God, this is the coolest thing we've ever seen. We're rolling it out in your portfolio. And I'm also rolling it out in like other portfolios that we know of." I'm like, whoa. Now, for founders, you need to appreciate something, okay? When you're a
Yeah,
strategic
yeah.
investor,
Product market fit.
when you're a strategic investor or a strategic VC, right? You're really looking for a strategic synergy with, whether you're a telco company or whether you're a real estate company. If your product is going to be used in my portfolio, I sort of have no choice but to invest,
Uh-huh.
right? Rationality goes out the window. I don't want to feel like, wow, I opened up a door for this startup. They're now being used in my portfolio, and I missed out on the opportunity to invest. Logic goes out the window, right? So, I'm like hooked now. I'm like, oh my God, this is exciting. My property manager's using this, and we're actually producing traction for the startup. I don't remember the actual amount of potential traction, but it was significant, right? Pre-seed startup, we become a major pilot customer.
Yeah.
We have to invest now, right? So we invested in the company. And that startup has now been executing at lightning pace and just, you know, in the space of, I think, 1 year as of this podcast, they've grown their revenues 30x.
Uh,
Okay. We didn't expect that. And you're talking multi-million dollar revenues from a startup that is just pre-seed. They've launched a debit card for renters. They've launched like a current account for renters. They've suddenly become this platform that is not just providing not just providing fintech products for the underbanked segment. Your underbanked segment is renters. Renters have a net worth of $6,300. These aren't people you can easily, bank very easily. You can't sell products to. Turns out, I think about 8% of their users have never even had a bank account before. So now
so they're doing low income housing, you're saying?
yeah, low income housing. I mean, they can do high income, not high income like, average rent, but a lot of what they do is lower income affordable housing, and there isn't a solution for this. I just find out from them there's a multi-hundred-million-dollar fund that's being set up to go buy real estate and to offer stake rewards to users. Stake has become ESG is a buzzword that means like environment, social, and governance, right?
Mhm.
Stake is becoming the S in that, the social part. You know, we tick a box, we buy real estate, and we do low income stuff, and we give stake as a differentiator. I've gone to some of my properties that use stake, and I'm hearing from our managers, we're able to charge higher rents than other companies around us just because we offer stake and consumers love it. It's like a bank account for renters. So that's just one case study, but that's sort of a journey of how that came along to be, you know? And then
And
five
in
minute
a
pitch.
scenario like that, what check size do you write?
Oh, I wish we put way much more money into this company. We put up overall in this company we've put $750,000. We started with like a 300K check, and
Uh,
we followed on at 450K, which is sort of how our fund operates. And sometimes when we're excited, we'll put SPVs together. We could be $1 million plus total check size in the company between seed stage and maybe follow on stage.
okay.
So that's sort of where we play. And
So
if it's pre-seed, we might just do 100K.
okay.
Yeah.
What else you're excited about? What else you've invested in? Let's do another case study. This was a wonderful case study. I think the fact that you're able to do pre-seed investment and immediately bring customers into a deal is nothing could be better than that for the entrepreneur.
That's what I felt. I thought, why try to be another VC, trying to be a generalist, competing with Andreessen Horowitz and Sequoia and all these others? Um, I thought, do I do a venture studio? No, let me actually set up a venture fund within a real estate company, you know, so agreed. I do think we offer good value and it's been proven. It helps us too, you know, it improves our revenues. I'll give you another case study and I'll give you sort of, this is like, there's such a word as anti-case study,
Uh,
okay? Um, Sometimes this shows you that VCs have no idea what they're doing. They come up with all these criterias, and when the rubber meets the road, everything gets thrown out the window. This is an investment I made before I set up my VC fund. And I'm telling you this because sometimes we don't know what we do. We get lucky, okay? And really founder strength is all that matters. We have a rule in our VC fund. Um, we only do like pre-seed and seed stage and pre-series A. So not
mhm.
late stage, right? Late stage is like, I would even say where we operate north of $20 million valuations. For us, that seems late stage. I like the $5 to $15 million valuation range. And we don't like hardware. This is my rule, okay?
Yeah.
Now I can share these numbers because these numbers are public. I made a personal investment in a startup called Boxable, which is like prefab modular homes.
Hmm.
And I didn't have any criteria except talking to this founder. He's just so much passion, so much excitement. He's trying to build like the Tesla for homes. I invested around a 40 to $50 million valuation. Okay. We looked at it at my VC fund and we passed on it because it was too late stage and it had hardware. Absolutely very easy pass.
Yeah.
Okay. And our thesis is if you invest early stage, you'll get insane 100x returns. This startup has been crushing it, like Boxable. And their most recent round was at 3.3 billion, and I only invested 18 months ago. It's been a 70x plus return for me.
Uh-huh.
I didn't think, like talk about FOMO. As a VC fund, we passed on a late stage company because it has hardware. We passed on it because we have to have a focus and we didn't believe you'd get good returns. How wrong were we? Right?
Yeah.
The strength of the founder is the only thing that mattered and their passion. And so I got lucky, like as a personal angel, right, in this investment. 18 months, that 70x type of paper return is great. But it just shows you, like, the
But
founder fit
but
is all that
I
matters.
actually think that your criteria for your fund is still correct because
Yes.
you got lucky with Possible. You could not have got lucky also very easily, and I think for a smaller fund, early stage fund, trying to play that late stage game doesn't always pan out.
It does. And
Usually doesn't pan out.
as for Samana, you're right too, and maybe for founders, you might appreciate this perspective. When I'm making an angel investment, I just want to feel good, and I don't want to do too much work on it, really, right? And I'll just write the check. As a VC fund, you have to go to LPs,
Yes.
you have to get money from them, and they're going to ask you, "What's your strategy? Why are you different?" And so
What's
you have
your
to say,
investment thesis? Yes, of course.
yeah, so you say we only invest in these types of companies. Here's our model. Here's the stage. Here's the valuation. Here's the equity ownership we go for. If we had invested in Boxable, at that point in time, it would have been a stupid decision because we can all agree on this. Whoever's listening to this will definitely agree. It's much easier in theory to see a 100x return when you're investing at a $5 million valuation, right?
Right.
Than you are at a $50 million valuation. Just statistically speaking,
Absolutely.
the law of small numbers and baselines. So yeah, we would have we. It's like stories of some companies, and this happens today, my God, some companies are putting their treasury in Bitcoin, which is really, I appreciate it, but that's not what your shareholders are paying you to do, right? When I ran my company, I really felt like we should just take all our money, cash money we have. My company did really well. It's profitable. At one point we had like 100 million plus in our bank account. We were thinking, where do we park it? And I was like, can we just go put it in some Facebook call options? Theoretically, my company would have made billions of dollars if I did that, right? But I would have been fired as the CEO because we are not a hedge fund. My job is to run a company and to build a startup. In the same way, you have to have a focus, and if you go out of that focus, you're breaching your fiduciary duties. You're
Yes.
doing things that do not, I don't know how you describe it. It's wrong, but it's
Do you know what you're describing, Zain, is some of it is you're describing it in terms of fiduciary duties and your
yeah,
to your limited partners and so forth. But if you translate that same thinking to entrepreneurs, you have to focus. Focus is a good
yeah.
thing. Not having focus, not having any, you know, organizing principle in your thinking and how you want to go about building companies doesn't build good companies.
Yeah, and you need to set expectations too, and you need to sort of deliver on what you say. If your founders, if your investors are saying, "Look, we back you, you do whatever you want, just swing for the fences," then swing for the fences. But if you're saying, "I'm going to build X," unless you update them and you give them a really good plan, you're sort of, my view is return the money back. If your pivot isn't working, return the money back, unless your investors are on board with the new pivot.
Of the improvement, yes, exactly. We do a lot of pivots, but investors have to be on board with the pivots. Zain, it's a pleasure. It was a very, very entertaining and educational conversation. So I'm sure everybody enjoyed it. Thank you for coming.
Thank you so much. Goodbye.
Bye.